Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Monday, May the 5th, Cinco de Mayo, and the year is 2025. Let's talk trading, weekly open and gap. These videos are for educational purposes only. Your results may differ from mine. And a friendly reminder, risk management. Always have your risk management in place so you don't lose more than you're willing to lose on any single trade or any single trading session. Oh, well, brain management. We haven't talked about this in a while, but you know, let's not have any fear, any regret, and just always remember that pain doesn't come from the market. It comes from your reaction to the market. So taking a look at the weekly chart here, we can see the dashboard tells us that all the gaps have filled. The pound gap down filled that gap, and we are now 77 pips above the weekly open, 12 off the high and 77 off the low. If we look at the monthly, we're right around the monthly open, just 2.6 pips above, 22 off the high, 76 off the low. And we are putting in the opening range for the week. We are inside the opening range for the month. As you can see, once again, we're right around that monthly open. For the year, we are 814 pips above the yearly open, 122 off the high, and 1,222 off the low. And like you see, we're right there. We're dancing at that monthly open right here. Now, some traders might wonder, why do I only talk about the pound dollar? Well, one of the things that, I've been talking about for decades in trading is you find that one thing that works and you just keep doing it till it stops working. Whether it's a method or trading a certain pair, trading a certain way, you just keep doing it. And sticking with one pair and one method gives you the advantage of not having to switch. And that, because switching can cause brain fatigue, and that's something we want to avoid when trading. And you actually get to learn the pair, because when you flip flop from one pair to another or one method to another, you're constantly having these variables, and you're having to focus on these variables, as opposed to you stick with one. Because what used to happen with me was, say I'm trading a pound dollar, and then all of a sudden I switch over to the yen, and I get in a fight with the yen. But then if I would have just stuck with the pound, I would have had a clear signal, and I could have made a boatload of pips. I mean, how many times do you miss out? And sure, you can create dashboards like I have, and it can tell you a lot across the board. You can spot those opportunities. And you can even set up automated trading, EAs or bots or whatever. But the thing is, you notice that they usually don't work well over the long haul. So if you just stick to that one pair, and when I was trading stocks, I used to call it, the cow. You get up early and you milk that cow, and it gives you milk every day. And the reason I called it that was because I'm here on the West Coast, so to trade the stock market, I'd have to be up about 4 or 5 o'clock my time, and that's when the dairy farmers get up. So to go out and milk their cows. So that's how that came about. And looking at the ranges, let's see, the pound Australian dollar still lead. Nope, we got the dollar yen here, 145 pips. And the pound's only clocking in at 89. And once again, you can see these. It's real easy to go, well, I should go trade this pair as opposed to that pair. Just doesn't work out well usually in the end. Usually if you can just stick to that one and just milk it. Some days will be better than others, but you can usually get something out of it every day. Looking to the left, you see all those wicks right there? What's that tell me? Before I could say it, did you see how quick that thing dropped? And that was the news. But yeah, I want to short out of that wick zone. In fact, I came up with a new indicator. In fact, let me load it up on a chart and maybe a little bit later, and I'll show it to you. Oh, that would have been really nice. Not only did it fall out of that area, fell out of the red rat zone. Been a nice little profit there. And as you can see, Bambino Flex said the short. The pivot trading plan said near the pivot is short. And right here at the would have paid off nicely. That pivot being at, call it 20. That's the weekly pivot at the 25. Now this is the daily. So I was wrong. I was looking at the weekly. The daily was down here, but that did pay off with the short the first time on the H4. The second time, well, you wouldn't want to trade short against the green H4 if that's what you're looking at. That wouldn't have been a smart trade at all. Price near R1 is short, and there we were right near the R1. That would have paid off again. So we've taken out the daily pivot, we've taken out the weekly, and we have not taken out the monthly in May. If you can see, this price is just pretty much nothing but wick zone here. And you can see we're at the 75% of the time price is going to be outside the wick zone. But when you have a bar like we did on Friday, actually, let me show you what that looks like. It's pretty much all wick. So that's what was going on there. All wick. So for the range so far, 89 right now, 0 percentile. As you can see, we have broken out of the previous week's low by 13 pips. We have not broken out of the high, so we've got lower high, lower low at the moment. Back to simple price action, you can see here breaking the previous H1 low there. Nice trade. And you can see that's a return bar. We just got a trigger here to go long at the 5. Try and pick up a couple of pips. There's your 2 pips. And see how, now you really have to be quick on those. And they just gave you a second chance to grab a quick 2. And there's that simple chart. So what I'm going to do is I'm going to pause the video and load up that other indicator that I've just been working on. I'm back. I've loaded it up, but as you can see, there's a flip-flop right there also, worth a few pips. I call this indicator multimeter bars to wicks. And what it does is it tells you how many bars you have to go left before you are in a wick zone. And the reason I did this is because I only want to trade or enter a trade if I'm in a wick zone. Because price doesn't like staying in a wick zone, and it seems like I'll get much better action. So for example, right here, if I enter this trade, if I'd entered this trade long inside that wick zone or right there, right at the edge, I would have made money. and ditto for here. See, I could have entered that trade right there. But if I enter outside that wick zone, yes, looking back, I can make money, but make much better entries if you're in that wick zone. Because a lot of times that's how I get inflected. See, right now I'm outside of a wick zone. So I would not want to enter that trade, because if I enter right now, it could just turn and go against me. Of course, it could go up too, but that's it's usually not as likely. Now, I said, this is a return bar. So the question is, will price go back to the open at 33.21? And it's Walmart. I know he would have probably had his TP here, because he likes to say, ride these reversal trades to the midpoint of the big bar, the return bar, or the big bar, however you want to call it. And it looks like my internet just go out. Nope, there we go. Big gap up. So right here, I'm in that upper wick zone. So this basically is saying I've got a trade opportunity. And so notice here, daily, weekly. Now, what these numbers also can show you is if you're in a support or resistance area. So if we look at M5, and it says, if you look to the left, it's like, oh, wow, this is indicating you could be at a support level here in the lower, or in the upper, you'd be at a resistance area. So if you really scrunch the chart, well, now you can't tell if there's a wick, but you can see right here, M15 and M30. See, right there, where previous support area. On M30, once again, there was a bounce right there. So that's how I'm using this. And I wrote a wick info indicator a couple of years ago that would tell the same thing, except it was just on the time frame you were looking at. But as some of you may know, that I really do like multimeters, because I can just a quick scan, like, out of the corner of my eye, I can see, do I want to be in this trade or not? Do I want to? So now I can sit on my hands and say, uh, price isn't anywhere that I would want to enter a trade. So right here, that would have been a really nice trade. Normally, I look out, because sometimes you'll get a sucker bar. If this first bar here, like, see, it started to go green or to the upside, and then it fell. So usually the first bar after a big bar like that, I call it a sucker bar. I just sit on my hands and wait. And by doing that, in a nice clear flip-flop box signal, you take your chance. And it could have been worth a lot of pips if you wanted to stay in. Though looking left, this might have been a point right here. Like I said, I'm pretty sure Walmart would have had his TP somewhere around the middle of that candle. So, fellow traders, fastest 15 minutes in trading is just about over. So let me know if you have any questions on what I discussed today. And I've got some more goodies that I'm going to show you later in the week. Because remember, not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.